Welcome back to the Deep Dive. I'm your host. And today we're looking at something that usually makes people want to run for the hills.
Oh, absolutely.
I mean, government savings legislation. Typically, when we crack open these bills, it's all about savings bonds that mature in 30 years or
With tax credits that are so incredibly complex, you practically need a PhD just to claim them.
exactly. It's dry stuff. But today is actually different. We've been combing through the sources of the new legislation, the One Big Beautiful Bill Act.
Yes, the OBBBA,
hmm
which is quite a name.
Right, that is the actual name of the bill. And specifically, we're looking at a new vehicle inside it called the Trump account. Now, before anyone reaches for the dial or, gets defensive, let's be very clear right up front. The branding on this is loud.
It is. It's practically screaming at you. It certainly lacks subtlety.
It does. But on this deep dive, we really don't care about the branding. We're not taking political sides here.
No, not at all.
We care about the mechanics. We care about your wallet. And tucked inside Section 402 of this bill is an arbitrage opportunity that is, frankly, well, it's unlike anything we've seen in standard custodial accounts.
That is exactly the right word for it. Arbitrage. I mean, the headlines right now, they're all focused on the free money aspect, the handouts.
Right, the baby bonus stuff.
Yeah. But if you look past all that noise and you look at this strictly through a financial planning lens, there's a mechanism here. It allows for a very, very specific type of wealth transfer.
And it's a strategy that requires understanding how this new bill intersects with existing IRS tax brackets.
Precisely. It's about how the pieces fit together.
And so that's our mission for you today. We aren't here to debate the politics of who named what. We're here to figure out how this machine works
Yeah.
and, how to drive it. Because while everyone on the news is talking about the baby bonus, the real story, the hidden twist in all of this, is what happens when the kid turns 18.
That is where the real value lies. It's a long game play. It really is.
So let's unpack this from the beginning. We have to start with the hook because that's what everyone is asking about.
Yeah.
The bill includes what is essentially a baby bonus.
Correct. This is the entry point for a lot of people. The legislation stipulates that any baby born between January 1st, 2025 and December 31st, 2028 automatically receives a one-time deposit from the federal government.
A flat $1,000, right?
Yep, it's a $1,000 grant.
Seed money.
Exactly, it's seed money. The government just opens the account, they deposit the grand, and it sits there. It's a government-funded investment account.
So if you're a parent of a newborn in that specific 4-year window, you don't really have to do anything. It's just automatic.
It's a total no-brainer for those parents.
Which is great politics, obviously. Free money for babies makes for a great headline. But this is where I think a lot of our listeners might tune out. They might be thinking, well, my youngest is 12, so I completely missed the boat. This doesn't apply to me at all.
And that is the single biggest misconception about the OBBBA right now.
That it's only for newborns.
Right. The $1,000 bonus, that free money, is limited to that specific birth window. But the account structure itself, the actual Trump account, that is available to any family with a child up to age 18.
Okay, so the vessel is open to everyone, even if the government isn't automatically filling it up for you.
That's the key distinction. If you have a 10-year-old right now, you can go to a brokerage, open a Trump account for them, and start funding it yourself. The legislation allows families to contribute up to $5,000 per year into these accounts.
$5,000 a year. Okay, so let's pivot to that family for a second. Let's say they didn't get the free check. Why should they care? Why go out and open a Trump account instead of just throwing that money into a standard high-yield savings account or, I don't know, a 529 plan? Because $5,000 a year is a serious financial commitment.
It is a serious commitment, and if this were just a standard savings account with a fancy political name slapped on it, we wouldn't even be doing this deep dive.
Right.
The reason you utilize this specific structure is because of the end game. It's about what the account legally transforms into.
This is the pivot point we found in the IRS guidance.
Yes. Under the rules as written, when the beneficiary turns 18, the Trump account legally converts into a traditional IRA.
A traditional IRA. Okay, let's pause here and make sure everyone listening is crystal clear on the implications of that. Traditional usually means tax deferred. You get a tax break when you put the money in, but you pay the piper when you take it out in retirement.
Right, the IRS is always waiting for its cut.
Always.
And you contrast that with a Roth IRA, where you pay taxes on the money now, but then it grows tax-free and it comes out tax-free. Generally speaking, financial planners will scream Roth from the rooftops for young people.
Because they have decades of compound growth ahead of them.
Exactly. You want all of that growth to be completely tax-free.
So On the surface, the fact that this Trump account becomes a traditional IRA, that actually feels like a downgrade. You're handing a teenager a tax-deferred bucket when you'd really prefer they have a tax-free bucket.
That is the initial read, and it's what throws a lot of people off. But here is the strategy. The sources we analyzed point out a maneuver that exploits the specific tax profile of an 18-year-old. The goal isn't to keep it as a traditional IRA.
You're not just letting it sit there.
No. The goal is to convert it.
You mean a Roth conversion?
Correct. The strategy is to take that traditional IRA the very day it converts at age 18 and immediately move those funds into a Roth IRA.
But wait a second. If I do a Roth conversion myself, I have to pay taxes on that money. The IRS treats the converted amount as regular income for that year. If I have $50,000 in a traditional IRA and I move it to a Roth, that's a $50,000 pop to my taxable income.
For you, yes. That would be incredibly expensive. But we aren't talking about your tax bracket here. We are talking about the 18-year-old's tax bracket.
Okay, let's run a scenario for the listeners. Let's invent a kid. We'll call him Little Leo.
Little Leo, I like it.
So Leo has had this account building up for years. He turns 18. He's a freshman in college.
Okay, let's look at Leo's financials as an 18-year-old. He's a full-time student. Maybe he works a few shifts at a local coffee shop or the campus bookstore. Let's say he earns, I don't know, $4,000 a year in actual wages.
So he's practically broke.
By IRS standards, absolutely yes. But this is where the standard deduction becomes the absolute hero of the story.
Right.
Every single taxpayer in the U.S. gets a standard deduction. It's an amount of income that is effectively taxed at 0%. In 2024 terms, that number is roughly $14,600.
I see exactly where this is going. That $14,600 is like a free pass from the IRS.
It's a bucket of empty space. If Leo only earns $4,000 from his barista job, he has over $10,000 of unused standard deduction remaining for the year.
So he can just fill that empty space with the IRA conversion.
Precisely. He can convert $10,000 from his traditional Trump account into his new Roth IRA. On paper, yes, the IRS sees that conversion as income. So his total income for the year is now his $4,000 in wages plus the $10,000 conversion, $14,000 total.
But since $14,000 is still under that standard deduction threshold, his federal tax bill is literally zero.
Zero. You've legally bypassed the tax liability.
That is a magic trick.
Yes.
You are effectively washing the money. You move it from the tax-deferred bucket to the tax-free bucket.
Right.
And because the kid is technically poor on paper, the cost to make that massive switch is nothing.
It's brilliant. If you did that exact same conversion at age 30, when Leo has a corporate job and he's making $80,000 a year, he'd pay 22 or 24% on that money to the government.
Wow.
But by doing it at 18, 19, and 20, during those low-income college student years, you lock in the tax-free status forever, for free.
So the Trump account is basically just a holding tank. You fill it up while they're kids, you wait for that legal conversion trigger age 18, and then you just slide it into a Roth while nobody is looking.
Well, while nobody is charging anyway, the IRS is looking. They see the paperwork. They just can't bill you because you're staying under the threshold. It turns the account from a nice little savings vehicle into a massive tax-free wealth engine.
Now, this brings up a really massive question regarding who can actually contribute to these things. Because usually when I try to get my nieces or nephews set up with a Roth IRA early, I hit a total brick wall.
Yes, the earned income rule.
Right. I can't just go open a Roth for my 5-year-old niece because she doesn't have a job. The IRS says you need earned income like a W-2 to contribute to a Roth.
And they are incredibly strict about that rule. They don't want wealthy parents using toddlers as tax shelters. Allowances don't count. Birthday money from grandma doesn't count. Babysitting paid in cash usually doesn't count unless you're actually declaring it. Unless the kid is working and filing, they generally cannot have a Roth.
Which is so frustrating because you lose those first 15 years of compounding interest. You're just sitting on the sidelines.
And this is where the OBBBA legislation totally breaks the mold. The text of the bill explicitly states that contributions to Trump accounts are allowable regardless of earned income status.
Regardless of earned income, that is a huge deviation from standard retirement rules.
It's massive. It effectively treats the contribution more like a 529 college savings plan, meaning anyone can put money in, but it puts it inside a retirement wrapper.
Right.
You can max out that $5,000 annual limit for a 3-year-old who does literally nothing but nap and eat crackers.
So you're getting a 15-year head start on a Roth IRA without the requirement of the kid having a paper route, or a summer job.
Exactly. And there's another detail in the source material that I found absolutely fascinating, the employer match provision.
Oh, I saw that in the notes. It looked almost like a standard 401k match.
It's very similar to that. The bill allows for up to half of that annual contribution, so $2,500, to come directly from a parent's employer, provided the employer opts to offer the benefit.
Wow.
So imagine a company offering Trump account matching as a perk to retain their employees.
Come work for us and we'll help fund your kids' retirement. That is a really powerful incentive for a parent.
It really is. So when you start combining these factors, no earned income required, potential employer matching, and the ability to convert to Roth at a 0% tax rate, you are looking at a very, very sophisticated piece of financial engineering.
It sounds incredible, but I have to pull the emergency brake here for a second. We were talking about locking money away for a newborn until they are 65 years old. It's an entire lifetime.
It's a totally valid concern. People get very nervous about locking up liquidity.
I mean, life happens, right? Little Leo's going to need a car at some point. He's going to need a down payment for a house. He might need to pay for a wedding. If this money is trapped in a retirement straitjacket with a 10% early withdrawal penalty, isn't that a huge risk? I think a lot of parents might hesitate to lock up $5,000 a year if they think their kid can't ever touch it when they need it.
That's the classic fear with any retirement account. I can't access my capital. But remember, once we execute that strategy at age 18, we are dealing with a Roth IRA. And Roth rules are surprisingly porous if you know exactly where to push.
You're talking about the principal rule.
Exactly. With a Roth IRA, you can always, at any time, for literally any reason, withdraw your contributions tax-free and penalty-free.
Let me make sure I've got this. So if I put in $50,000 over the course of 10 years, Leo can take that exact $50,000 out at age 25 to buy a condo, and the IRS doesn't care at all.
Correct. The principal is entirely liquid. It's only the growth of earnings on those contributions that are restricted by the age 59.5 rule.
Okay.
But even there, the OBBBA and the existing IRS codes offer specific escape hatches for young adults.
What kind of hatches are we talking about?
Well, the biggest ones are for education and first-time home purchases. The sources specifically note that these accounts retain all the standard IRA exceptions, so Leo can actually use the earnings to pay for qualified higher education expenses without getting hit by that 10% early withdrawal penalty.
Okay, so it essentially doubles as a backup college fund if you needed to.
In a way, yes. And for a first home purchase, there is usually a $10,000 lifetime limit on penalty-free withdrawals of earnings. So between the completely accessible principal and these specific exceptions for life events, the money isn't nearly as trapped as people assume.
That drastically changes the narrative for me. It's not just a retirement account for a toddler. It's more like a life launchpad account that eventually becomes a retirement account if you don't spend it all.
It bridges the gap perfectly. It provides accessible capital for those early adult milestones while keeping the remaining balance in there growing tax-free. And, there's one more technical benefit we really should touch on, which is the kiddie tax.
Oh, right. The tax on unearned income for children. That catches so many people off guard.
Usually, if you open a standard brokerage account for a kid, like a UGMA or UTMA custodial account, and they make too much money from dividends or stock sales in a given year, they get hit with the kiddie tax. And that taxes their unearned income at the parent's highest marginal rate. It is nasty.
Yeah, it's explicitly designed by the IRS to stop exactly what we're talking about, shifting wealth to kids in lower brackets.
Exactly. But because the Trump account is formally a qualified retirement vehicle, the growth inside it is tax deferred during those childhood years. It doesn't generate annual 1099s. You don't have to worry about the kiddie tax biting you every April.
That simplifies the paperwork immensely. You literally just fund it and forget it until they turn 18.
Until the conversion window opens, yes.
So let's look at the long-term impact here to wrap this up. If a family actually maxes this out, $5,000 a year, and they manage the conversion correctly at 18, what are we really looking at for the kid's future?
Well, without getting bogged down in endless compound interest spreadsheets, just think about the sheer timeline. If you have, say, $80,000 sitting in a Roth IRA at age 22, and you just don't touch it.
You just let it ride.
You let it ride for 40 years. Even with very conservative market returns, you are looking at a multi-million-dollar asset that is completely 100% tax-free.
That is the power of the timeline, the eighth wonder of the world, right? Compound interest.
And because it's a Roth at that point, the government gets 0% of that final number. That's why the strategy outlined in these sources is so incredibly potent. You are paying taxes on the seed, which is nothing because the standard deduction hack, and you are harvesting the crop decades later for free.
But the key to all of this is that conversion window. If you miss it, say Leo gets busy with college and waits until he's 30 and making big money to do the conversion.
Then the door closes. Or at least it gets very expensive to walk through. If Leo is in the 24% tax bracket at age 30, converting that account is going to cost him 24% of the balance. The hidden wealth strategy is entirely dependent on recognizing that specific window of opportunity where the child is technically an adult legally, but financially not yet a high earner.
It really emphasizes that financial planning isn't just about saving money in a vacuum. It's about timing.
It's about life stages. We often think of tax planning as something you scramble to do in April, but real generational tax planning is looking at the entire timeline of a life birth, age 18, first job, marriage, and finding those trigger points where the rules change in your favor.
And the age 18 trigger in this specific bill is a massive one.
It is. It's a distinct legislative window. And honestly, it raises a really provocative question for everyone listening to this right now. If this specific window exists, this age 18 conversion opportunity, what other life stage tax triggers might we be ignoring in our own financial planning?
That is a great point to leave off on. We spend so much time maximizing the current tax year, we completely forget to maximize the decade.
Exactly. And the Trump account is just one example of this. The tax code is full of these levers if you just know when to pull them.
So to quickly recap the roadmap for little Leo and for everyone listening who wants to take advantage of this.
Step 1, open the Trump account. Get the seed money if you're eligible in that birth window, but fund it yourself regardless. Up to $5,000 a year, and remember, no earned income needed.
Step 2, let it grow tax-deferred throughout their childhood, avoiding all those kiddie tax headaches.
Step 3, at age 18, the account automatically legally converts to a traditional IRA.
Step 4, the pivot. You execute the Roth conversion while the kid's income is still under the standard deduction threshold, which is roughly $14,600 right now.
Resulting in Step 5, a tax-free Roth IRA that offers penalty-free principal liquidity for college or a first home, and eventually a completely tax-free retirement.
It's just amazing how a slight tweak in how you view a government program can unlock so much more value. It's not just about the $1,000 handout. It's about the handle you use to crank the machine.
That's the main takeaway from all the sources. The check gets the headline, but the tax structure is the actual wealth builder.
Well, I certainly feel much better equipped to navigate the OBBBA now. It's not just a catchy name. There's some serious machinery under the hood if you know how to drive it.
Indeed. It's a remarkably powerful tool for those willing to look past the political branding and actually read the fine print.
Thank you so much for breaking down the math on that today. The standard deduction insight really connects the dots for me.
Happy to do it. It's a fascinating strategy.
And thank you to everyone listening. Hopefully this gives you a brand new strategy to consider for the young people in your life. As always, if you found this deep dive useful, please share it with a friend who loves a good tax strategy. We'll see you next time.